A video game retailer worth $12 billion just tried to buy an online marketplace worth $46 billion, and got shut down so decisively that the rejection letter is now a case study in corporate brutality. GameStop CEO Ryan Cohen offered eBay $56 billion in early May. The number sounded enormous until you looked at where the money was supposed to come from. GameStop's entire market value was less than a quarter of that. To close the deal, Cohen would have had to issue so much new stock that existing shareholders would be diluted into oblivion, plus load the combined company with $20 billion in debt. The plan hinged on a financing letter from TD Bank that promised the $20 billion, but only if the merged entity maintained an investment-grade credit rating from at least two of the three major agencies. eBay's board read the proposal and immediately spotted the trap. A combined GameStop eBay would almost certainly not qualify as investment grade. GameStop's balance sheet is shaky. eBay's debt load would spike. Credit agencies had already signaled they'd downgrade eBay if this deal went through. The financing commitment was essentially a promise that would evaporate the moment anyone tried to use it. It was the corporate equivalent of offering to pay for a house with a check you know will bounce. On May 12, eBay Chairman Paul Pressler sent Cohen a rejection letter that didn't bother with diplomacy. He called the bid neither credible nor attractive and listed 6 specific problems: uncertainty about financing, damage to eBay's standalone growth prospects, operational risks, governance concerns, lack of strategic rationale, and the simple fact that eBay is better off without GameStop. The letter was so blunt that analysts started forwarding it to each other as an example of how to kill an unsolicited bid in writing. Cohen had tried to frame the deal as visionary. He said GameStop's physical retail locations, mostly mall stores selling used video games, would somehow help eBay build a national network. He'd been quietly buying eBay shares for months, accumulating about 5% of the company, positioning himself to take the bid directly to shareholders if the board refused. He presented the offer as a 46% premium over eBay's February price, making it look generous. But the board saw through it. Paying a premium with stock you're about to dilute and debt you can't actually secure isn't a premium at all. The mechanics of the bid reveal why it was doomed from the start. GameStop would have needed to issue roughly $32 billion in new equity, nearly 3 times its existing market cap, just to cover the stock portion of the deal. That kind of dilution would have tanked GameStop's share price, which would have required issuing even more stock, creating a death spiral. The debt portion required GameStop to convince rating agencies that a meme stock retailer with volatile earnings could service $20 billion in loans while also managing eBay's existing obligations. No serious analyst thought that was possible. What makes this story stick isn't just the audacity of a small company trying to swallow a giant. It's the gap between the marketing and the mechanics. Cohen sold the bid as bold and transformative. The financing letter was designed to look solid, TD Bank's name carried weight, and highly confident sounds reassuring. But the fine print made the whole structure collapse under scrutiny. eBay's rejection wasn't just a no. It was a detailed explanation of why the offer was never real in the first place. GameStop's stock dropped after the rejection. eBay's held steady. The market had already priced in the likely outcome. Cohen's next move is unclear, but the hostile takeover path is effectively closed. You can't force a board to accept an offer when the financing depends on conditions the deal itself makes impossible to meet. The bid is dead, and the autopsy shows it was never really alive.